Hi, thank you so very much for tuning in to Let's Talk Money. I'm Money T.
I am Simply C. Well, today we are going to be talking about building your child's financial future through life insurance and investing with insurance extraordinaire Randall Fears. Randy is a life insurance agent and broker. He's got 30 plus years of experience. He is licensed in several states, including Texas, Kansas, Missouri, and one of my new favorite states, Georgia. He is representing 15 plus major carriers, and he know all the things. So, Randy, welcome. Crowd go wild. All right, welcome.
Crowd noise. Thank you all. Thank you all so much for having me this morning. Once again, it's good to be here. Good to see you virtually.
Yeah, Randy is a returning.
I'm excited about this.
Yeah, Randy's a returning guest. So thanks for coming again and carving more time out of your schedule.
Yes, we appreciate it.
So we're talking children's insurance, and I think this kind of stems from a conversation that Randy and I were having. I have a life insurance policy for my granddaughter, and I was listening to this video about insurance policies you don't need, right? And insurance for your child was one of them. So, Randy, you recall that conversation? You want to chime in here? What were we talking about?
Absolutely. Let me give a disclaimer first. So I am a registered rep with Royal Alliance Advisors, which is a broker dealer, and so I do insurance and I also do investments. So we were talking about life insurance for children, and basically what is the best way to set up a child's future, and that's kind of a twofold question because we're looking at two different things in terms of having dollars for a child's future. There's no better way to do it than put 100% of your dollar into a savings plan or an investment plan. If you want to make sure you have the right amount of money for them to be accessible in the future, whether it be for college, whether it be for their first car, or whether it be for that wedding in the future, and you want to make sure that you are putting 100% of your dollar into a plan, a savings plan, or investment plan. Because any insurance plan that you use for your child's future, there's going to be some expenses, right? Mm-hmm. There's going to be expenses for the cost of insurance, and there's going to be maybe some administrative expenses. So you can accumulate dollars for your child's future inside an insurance policy, all right? But it's not going to be 100% of the dollar that's going to go to the investment. So we're kind of talking about two different things, mm-hmm. Apples and oranges. So when people say, should I have insurance for my child? The answer is yes, okay? For a lot of young couples and young families who are trying to buy their first house, get a new refrigerator, fix their car up, that type of thing, a lot of times they will buy a term policy for themselves, and that term policy will have a rider on it for their children. Now, a child rider, you can get it in different increments, 5,000, 10,000, 15,000, all the way up to maybe 50 or 75,000. And the more kids you have, the better a deal it is. Okay, so let's say I'm married and I have children. The rider for, let's say, 10,000 might cost $4.50 a month. And it gives every child that you claim as a dependent 10,000. Okay? So if I've got one child, $4.50 a month. If I've got 10 children, it's still $4.50 a month.
Really?
So be ye fruitful and multiply.
No, don't. Please don't.
So for a lot of people, for a lot of my young clients that I've through the years, the child rider has been a good way to cover the children. Once the child is 15 days old, you can add another child, usually by a form, or some companies just let you do a letter. And this is another reason why you need to have an agent involved and not just deal with policygenius.com or, terminsurance.com, because we keep up with you and find out. And those are kind of like little things that go off to us when we hear that something's going on. Well, we need to add that child onto the rider. Okay. So and the rider, usually the kids are covered until age 25. All right. Some policies have a little different wrinkles, maybe 26, but it's a good way to cover the children and make sure they have insurance. And people go, okay, well, why should I insure my child? Because they can get it later in life. Well, remember, good health buys insurance.
Mm-hmm.
All right. So it doesn't matter how much money you have. If I have a child that has a condition, cancer, sickle cell anemia for the Black community, or some, and they develop some other type of debilitating illness, then they may not be able to buy insurance in the future. So at least with the rider, you can actually have coverage for them. Now, some people want a specific policy, maybe for their child, because they realize that when people get 50 and 60 and 70 years old, it's expensive to buy a policy.
Yes.
So they say for people that have the money, I'm not naming no names, but people like y'all have money, so you may say, you know what, I want to buy a policy for my grandchild, and I want a lifelong policy, so that, and I want to pay for it in 10 years or 15 years.
Mm-hmm.
So what happens is some insurance companies sell small policies, 25,000, 15,000, 20,000, 50,000, and you can actually scrunch those premiums up like an accordion from being a lifelong policy to like a 10-year pay.
Right.
So the whole idea is, like your car. Do I want to buy my car and pay for it for 7 years, or do I want to pay it off in 4 years? It's the same thing with the life insurance policy. So where a $25,000 whole life policy for a child might cost $6 a month, if I'm willing to pay $20 a month, I can pay for it in 10 years. And now that child at 10 years has a policy that's paid up for the rest of their life, 50, 60, 70, 80 years old. No more premiums have to be paid. It's just put in the drawer. So it's kind of like if your grandmother bought a house and left it to you, right?
Right.
That's your house. It's a piece of property. You just own it.
So is it a big gap in premiums with the whole life and the term? So, or do people just not know about it? Is it not talked about?
Great question. So what's interesting about the insurance industry is for kids, you usually can't buy a term policy until you're 18 years of age. So like my kids, for example, once they got college age, you could buy $100,000 term policy for them. It may cost $10 a month for 30 years.
That's awesome.
Because I'm like, okay, I don't know what they out there doing. I don't know how they living, who they hanging around. But my thing is, while you're young and while you're in great health, because, we all skinty when we're 18, right? We ain't got no health problems, right?
Right. Usually, yeah.
So you buy this cheap term policy, and I own it, okay? So I'm paying that $10 a month, $11 a month. I own that for 30 years. I don't have to worry. They're going to change jobs 5, 7 times, 10 times, okay? And having that coverage is good, okay? But the thing about it is, I know if something happens to them, $100,000 is going to be there because I want to take care of their kids. I want to make sure their student loans are paid for. I want to make sure, and I want to lock in that level rate for 30 years.
As long as you can.
Or as long as you can. On the other hand, under 18 years of age, usually you're talking about some type of whole life policy. You see the Gerber on TV where it's $1 or this, and that's the type of where it'll jump up. The premium will jump up once they get to a certain age. Or you can, like one of the companies I use, they offer a 10-year pay. And so a lot of times that's what I talk to people about, because I'm like, get it done and get it paid for. But if they don't want to do that, they could pay $6 a month, $9 a month, for as long as they want to have the policy.
So what does that look like? Say I have a 5-year-old and I want to get a whole life policy that is worth $50,000. What does that payment look like in the amount of years?
I would say if you're doing a lifelong policy, $50,000 for a 5-year-old probably be about $17 a month. Okay, if you're going to scrunch it up into a 10-year pay, it would be more significant, probably about $45 or $50 a month, because what you're doing is you're accelerating the payment to get it done in a 10-year period.
So,
because the $17 was how long?
$17 would be for life,
lifelong.
for as long as that person lives. So for me, it's a thing. I'll say, hey, you can pay the $17. That's $204 a year. Your child is 5 years old. If they live to be 90, you're going to pay that for 85 years. That's $17,340 a premium. Okay? If the policy costs $48 a month, that's $576 a year. Times 12, that's $6,900 a year. Okay? So if a person can afford it, in the long run, it's a great deal. But here's the thing. People will say, well, I've got this mutual fund that I'm putting money into, and I was told that I shouldn't buy the insurance. I should take that money for the mutual fund. I said, I totally agree with you. If the focus is on cash accumulation, on investments, on anything like that, then put it in the investment. But we're talking about two different things here.
Sure.
Because the insurance, number one, we're protecting their insurability. We're making sure that they have lifelong insurance coverage, right? Number two, it does have a cash value to it, but we really can't compare that little putt, insurance growth with a mutual fund or, exchange traded fund, right? Two different things, It's like saying, we can compare a 7th grade basketball player, with LeBron James. It's two different things, right? So everything has its purpose. There is no, I want it, everybody want to go to heaven, but everybody ain't going to do right.
Right.
Oh, that's kind of a bad analogy. I shouldn't be bringing that into this. But praise the Lord anyhow.
So question, can you borrow against your whole life insurance?
Yeah. And so it's kind of like, think of a whole life policy as kind of like a mortgage. Okay, so when you first buy your house, most of your payment goes to interest, right? So you're building up very little equity in the house. So you really don't have a lot of borrowing power, okay? And it's the same way with policies. But after a few years, the policy does grow in guaranteed cash value, and then it also has a dividend for some companies. And that's money that can be borrowed, usually, 4 or 5%, something like that, maybe 6%. I tell this story all the time. I started an insurance business when I was 28, and I bought a whole life policy for myself. $25,000 policy cost me $45 a month. Okay. Term insurance policy that I had at 28 back then, $100,000. I want to say it was something like about $14 a month. So people would go, why did you buy that $25,000 for $45 a month? And it's a lifelong policy. Okay. When you got this term insurance policy for $14 a month. I was young, I was married, and had 2 children. Well, I bought it because I was in the business, and I didn't want to sell people a whole life policy and not have a whole life policy myself. Okay, y'all, I had this Camry. I want to say it was, I can't remember what year it was. It was an 80-something Camry, or maybe it was a 90. I can't remember, but I had this policy, and probably about 4 or 5 years, maybe 5 or 6 years into this policy, the transmission went out on the Camry. And we was crying because, we didn't have no money. And I picked up the phone and I called Franklin Life, which was a company that I was selling for. And they said I had a couple $1,000s in the policy and I could borrow the money out at 5.25%. So I took my car up to Keith's Transmission on Leavenworth Road, and I had that transmission dropped in my car, and I paid for it with the loan on the policy. Now, here's the thing about the loan on the policy. Number one, they don't ask you where you work. They don't ask you how you're going to pay it back. All they do is they give you the money out of the policy, and they charge you a year's interest in advance. Okay? So if it was a $2,000 loan, it was 5%. $100 of interest.
Is that your money though? Is that your interest, or they're taking that money, or is that going back?
They're taking the interest on the right.
Boo.
And then what happens? Because they're charging you. They're charging you
to use your money.
Equity, charging you equity out of your policy, right? So what happens is, they're charging you just like anybody else. And what happens is, when you pay that back, that equity goes back into your property, just like a home equity loan, right? If you get a home equity loan, it works the same way, right? Only you got to go tell them how you're going to pay it back, that type of thing. Here, you don't have to do that. So it helped me get that transmission, and we was up and rolling again.
Beneficial.
So typically, you should pay the loan back over time. You try to pay it back over time. But if something were to happen to you, I had that $25,000 policy. If I would have got hit by the milk truck, and then
they had milk trucks back then,
would have paid $25,000 minus the loan, right? So $23,000 would have been, or $22,900 would have been paid out, right?
Okay.
So it comes in handy, but really, people, unless you're really, trying to build a huge net worth through buying huge whole life policies, which like some rich people do, then you're not going to build up a whole lot of equity, in the policy, but it is there.
Because rich people will use it and buy real estate and things like that.
Absolutely. There's a whole series of books out there. One, my favorite, is called Become Your Own Banker. And it talks about how people buy huge whole life policies when they're young, build up a lot of cash in them. Now you got $35,000 of cash in there rather than going and getting a car loan through your bank and hitting your credit score. All right. Now you borrowed from the policy, and it doesn't even matter because that's not part of your credit score. Then you borrow the car, you took money from your policy to pay for your car. Now you pay the loan back into your policy, so you're being your own banker.
I like that. I like that concept.
Yeah, it's pretty cool, and there are some people that really apply it and use it well.
That's the applying it and using it well.
Exactly.
That's the part that's important.
Like that, unlike, some other people that are just like, it's there for emergencies. It's there for, to build an asset or, to increase your credit score to build your network.
So I had a question about the rider part. So what happens to that policy if the parent passes? So if you don't get a separate policy for the child and decide that you're going to put them on as a rider instead of that while you're investing the money for them, what happens to those policies? Because we kind of talked about lapsing. If a policy lapses, then you no longer.
Yeah. So if a parent has a child rider on their policy, or if they have a spousal rider for a spouse, and if they change banks and they forget to tell me, or if they lose their job and the policy lapses, usually, first of all, usually there's a 30 to 45 day grace period if you miss a premium. Okay, in this day and age, you might get a text message, you might get an email, hey, somebody, and so that's a chance for you to fix that before the 30 or 45 days, depending on what company we're talking about. But after the fact, if it lapses, most companies will give you 6 months to reinstate the policy with the caveat that you have to prove good health again. Okay, so if your health really hasn't changed, you could reinstate the policy, pay the back premiums. Okay, if it's been 2 or 3 months, pay the back premiums, and then you're still on that same 20 or 30-year term period that you were on. If it lapses and you don't reinstate it, now everybody's coverage is gone. And you got to start over at the new age, right? And I think the other part of your question was if something happened to the parent, what happens to the coverage? Normally, the insurance company will give you an opportunity to convert that coverage to a policy for the kids. Okay, if there was a early death by the parent. Also, when the kid becomes close to 25, they usually will give you a letter or something, say, hey, we saw Randy is approaching his 25th birthday. If you want to convert this to a policy for him, or if he wants to convert it, you got 30 days and this is how much it would cost. And a lot of parents be like, what? This person is he's old enough now, he can get his own policy.
That right there. Yeah.
Look, I'm waiting for him to get an apartment. You talking about getting a policy, another policy for them. Okay.
I know, and I was thinking about if they had to do a whole nother health assessment, their policy or the premium now would be assessed at whatever their health condition is at that time.
And age, right?
And age. So you want to make sure that those premiums get paid, to the listeners. If you already have a policy, you want to make sure that those premiums get paid. If you change banks, you want to notify your agent so that you don't miss a beat in there, and you can make sure that coverage continues. Because it'd be more money.
Right.
Could possibly be more money.
Well, I talked about in that from day one.
Yep. So we're getting all this good insurance info from brother Randall.
Right. She done went to church on us.
Hallelujah.
Hey guys, and thank you once again for tuning in to Let's Talk Money.
You can find us here every Monday at 8 a.m. Central Standard Time.
Yes, so be sure to subscribe and hit the bell notification so that you will be alerted every time new content is aired.
Come on, y'all. Tell your mom and them, your cousin them, all of them.
Tell them all.
Tell them to subscribe and listen to Let's Talk Money.
Yes, and be sure to leave us some comments. Chat with us. We'll be chatting live at times, so chat with us.
Hey, remember, your money mindset matters.
As a man thinketh in his heart, so is he.
Peace, y'all.
Peace.